You can go like that. Yes, sir. Yes, sir. Yes, sir. Yes, sir. Doo-doo-doo. Okay, 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 okay. Doo-doo-doo. Let's do this. Be link. Be link. Yo, 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 yo. Yo, 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 yo. What up, what up, what up, what up, what up, what up? Um, uh, yeah, talk about it. Be about it. Let's talk about it. Be about it. Let's talk about it. Be about it. Talk about it. Be about it. Link. Yo, what's up? What 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 up? Talk to me. Hold up. Send the link out. Sending the link out. Or Powell hits the stage. I mean, hashtag Powell. I think they're just gonna pause on rate cuts, boys. They're gonna pause on rate cuts. No, you can't do it on TikTok. It's already there. I guess we could do it on these guys. Bro, picture. Yo, what's up? What's up? For Powell? Up or down? Up or down for Powell? Up or fucking down for Powell? Check. Down. Yo, yo, yo. Yo, 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 yo. What? Oh, there we go. Final. All right, whatever. We out. We out. We out. We out. We out. We out. Yeah, yeah, yeah. Peaceful today, boys. Very peaceful. 10:53. It's like 4 minutes fucking delayed for real. Ultra latency. Ultra latency, boys. Whatever. I mean, FOMC statement. I think they're pausing rates. Not pausing, but they're just not. They're not gonna do anything. The rates right now. Let's see what they say. 2 minutes. 2 minutes till we come out of it. There's a need to be analysis. Let's see. Let's say down, bro. Let's say down. Let's say downtown, baby. Could be wrong. I could be wrong. Right before right before news happens, all the market makers pull their limit orders off. So whoever presses market order first with those freaking high frequency computers, it will fill at the best price. So that's why you see an expansion or a gap in liquidity when the news hits. There's a gap in liquidity when news hits. Got 20 seconds. 20 seconds. 20-second, boys. What we got? What we got? 5 seconds. 5 seconds. Bagoom. What? See? Fed rates leave them unchanged. Fed rates are unchanged. Unchanged Fed rates. Let's see what it says. Fed leaves rate unchanged. Nothing. Told you. Already priced in. Damn. What a week. Yo, FOMC nowadays is weak as shit compared to when COVID was here. Like 2021, 2022, end of 2022, or beginning. Nah, yeah. Now, ass, ass, bro. Fairly ass. That's really ass. Fed signals modest rate cuts, sticky inflation. You see rates at 3.4 in 2006. Modest 25 BPS cuts 2026, 2027. Inflation forecasts were revised 2.7. Unemployment holds at 4.4. Yeah. Middle East uncertainties. That's why they paused it. So you guys were trying to pass your evals with that FOMC statement. You're fucked. Shit was only a modest 24, a weak ass 24-point candle. Weak, 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 weak. How come this shit's so slow? Look at this. You know what I mean? Man, it's slow like this YouTube. Wow, so boring. Yo, Euro to G was good. You do binary? No. Binary, you mean binary options with the time? You gotta bet it in within like 15 minutes if it's gonna be high or low. Nah, don't do that shit. I mean, I don't do that shit. It's like more of a gambling in 15 minutes. You don't know when the whales are coming in 15 minutes or not. You start at 7 a.m. is Central Standard Time. That would be what, 8 a.m. Eastern Standard Time? Nah, I wait. I'm on the charts by 9 a.m. Eastern Standard Time. 9 a.m. Just gotta like mark out. I already have my auto plotted levels. I got my volume profile, VWAP, and my MGIs, and then volume footprint candles. That's it. If you're day trading, that's all you need. Day trading, that's all you need. Fucking like 160 point range. Look at the stack bullish and balance right here. These four levels, but you could expect that on FOMC news events. Uh, I don't think the whales are coming out after this. We'll see when parole Jerome Powell starts speaking. But this stacked and balance right here, it should hold if you're on longs. This has to hold here. I mean, buyers came in right here with this bullish imbalance here, 43 right now. So they're coming in. They're coming in right here at the 85s. But they're not huge buyers. They're just, you know, they're just three times more buyers at the 85s right now. So we'll see. Maybe it'll hit VWAP and then when Powell starts speaking, sellers are gonna come in. Ooh, ooh, ooh. I go live when I fucking feel like it. No schedule going live, guys. There's no schedule going live. Every time I'm on live, everyone asks me when I'm going live. I don't know. There's no schedule. I just go live and that's it. Then you guys could just rewatch the lives. I don't go live until after I trade. I don't trade. I don't trade with public. I have a small group. You got a small groupie. I mean, you guys get the second live or the third live. Still good information and better than nothing. Point of control just changed here. Let me just hold on. Uh, trading views is when you're on the 1 minute trading views point of control line. Fucking around. Point of control just changed here. Point of control right here, a dotted line is just meaning that there's fair value. This is the area where buyers and sellers agree on price for the most part for the session. So at 900s is where sellers and buyers were really active, and they're buying and selling at that price level or that price point because it's fair value. Sellers agree and buyers agree at that price. So when you see price go sideways, that's what it means. Or when POC comes there, that's what it means. We have here another bearish imbalance here, but nobody's coming in until Powell's speaking. No one really significant, large volume here. But when you're in a trade and POC changes, like if I was in a trade and POC changed right here, uh, fucking either um, go to break even or just cut it. I would just cut it. I cut it usually. You don't want to get stuck here. You're just gonna range here, which we're probably gonna do until Powell starts speaking. This is where my POC just dies out. Yeah, that's why I have it in white. The background's like black, so when I see that white box on my right, I know point of control just changed. Let me go update the. You gotta go back. But on the 1 minute, you gotta go all the way back for it to update. I don't know why. I don't know what kind of fucking bug that is with TradingView. Because you could see it on the 5 minute. You can see the POC on the 5 minute. For the volume footprint candles, you got to keep it zoomed like this, right? So for me, I have this on my my big monitor, and then you can have on a side monitor. You can have your 5 minute like this, so you can see where we are in the market right now. So we're in the middle of the range. That's value area high, value area low, right in the middle. See it always coming back to the mean. The mean, I'm saying like average price for today, right there. Boom, 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 boom. Still short term bearish because we're under VWAP, but we'll see. We'll see if we try to break out. Try to break out when Powell's speaking here. I mean, it could be a great play for us to break out. But the FOMCs recently is just like it will probably just stay in this range unless he says something crazy, or unless like Trump front runs him, right? Like, oh, they cut those rates. I mean, they paused those rates. Oh, that motherfucking Powell. That stock market's gonna go higher when he leaves. Then shit might pump. You know what I mean? No. We're at the 900s right now. How do you make the whale purple line? Are you using fib retracement tool? How do you make your whale purple line? Oh, like which whale paper purple? I know there's no whales on my chart, but what purple line are you talking? This purple line is VWAP. This purple box is just stack bearish imbalances. Stack bearish imbalances. Oh yeah, no, I have it right here. It's it's this tool right here. What is this shit? Rectangle box. Yeah. When you do like this, right click, moving, extend it to the right. You hear extend to the right, and then you can change your background color, whatever color you like. Right, that green, that's a whale. That's a green whale, and then this purple is my what do you call it? The Suller whale. That's a good video, bro. I'm gonna do a video on that. Yeah, rectangle. It's on your left side. Drawing tools. Choose rectangle. You'll see it. Make sure you extend it to the right. Good. Let's see what happens if it hits value area low. If it come back to the mean. Mm. I didn't think it was gonna be this fucking boring. My bad, guys. I don't know if it's this gonna be this boring. Let me update the Discord, broskies. Um, where was I? Was it 18th? Yeah. What the fuck? Oh yeah, here. It's me. Oh, yeah. Those row size have to be manual. Yeah, I'm like, what the fuck? Where am I, bro? I'm lost. Okay, cool. Oh yeah, okay. I know where I am. First one since 3-day losing streak. That's what's up. Let's go. Yeah, Monday and Tuesday is crazy. Monday no trades. Tuesday one winner. Today I am slightly red. Waiting for this Powell guy to come out though. Job's not finished. This one says 3-day losing. Cool, bro. What is it? Min Q. All right. Good day on hit. All right. I see you. Got the move down, huh? Matrix. On your trade seems plus combination help center when you go live right now. YouTube. We got 15 minutes till Powell comes on, guys. Let me know if you got questions. Right now, no volume actually. If you look at the ATR, we're at 15 right now. 15 points for every 15 candles. So it's just like a normal ass PM session. Do this shit. Ah, this here, bro. Nah, I gotta get to the bottom of that. How do you stop these damn scammers on Discord? They even try to get you to do one-on-one chat. Like, how do you do one-on-one chat, bro? Uh, Buyer said, I'll let you have it right now. They selling before they get in here, huh? They selling before Powell gets here. All right, we're at value area low here. Let's see. Coming back. Get some zero prints. Maybe that's the market makers just not even providing liquidity right now. We're good to go with the Discord, boys. Fire. Yeah, man. Yeah, no AD candles, man. Yeah, I'm only Trade Mellow. My name is Trade Mellow on Discord. Not nothing Trade Mellow 1, 2, not Trade Mellow dot dot. I watch and I'll never DM you, bro. I'm not gonna be like, yo, you want a one-on-one? I'm not gonna be thirsty and start DMing you, bro. I'll never DM you unless you DM me first. Or- 12 minutes. 12 minutes till this guy starts speaking. Do it on YouTube. Let's see if I can get it on YouTube. Where is it? Associated Press. It's, oh yeah, FOMC press conference. Yeah, there you go. Federal Reserve. Federal Reserve. Federal Reserve. 10 more minutes. 10 more minutes. So you go back to point of control here. Springtime. This Friday, spring. Yeah, May 20th, March 20th. Oh, bro. Yeah, I see. You getting one will be out. Right, hitting my area low at 820s. Let's go. Let's see. Right. Damn it, he took GG. Should have just took him. That won't add to his odds. It's really fucking nothing, bro. 7 minutes. 7 minutes until we get to the bottom of this Powell talk. Y'all were red, green today? Who's red, green? Who is red and who is green? Sir, green like a green bean. I like it. I like it. 6 minutes. 6 minutes. Crude oil is gonna keep going higher, man. I think the first 3 months, crude oil is gonna go higher, and then it's gonna go lower. Come on, Daddy Powell. I love that. Yes, sir. Yeah, I don't look at anything else but NQ. I get a headache if I just jump between assets. You get what I'm saying? So I don't get why like people look at like I get it, but I just can't have like 7 monitors, bro. 8 monitors. Like one little thing on the right monitor or the left monitor gonna change your mind? I don't fucking know, bro. 4 minutes. What AI tool do you recommend? Um, none. I don't use AI in my trading. Should though. Well, like the code. I want to see someone code my strategy though. That'd be dope. Like, Oh shit. What are you talking about, bro? 2 minutes. Let's see. Put the headphones on for Daddy Powell. Where is he? Yes, sir. You already coded it. Wow. Send me the code. I don't even know where to begin. Send me the code. How to use the code. Show me. Was it like a bot? What would you like for AI to automate for you? I mean, I could just turn off my fucking uh, trading view, and then I wake up and I could see it traded for me, and I made money. Me pressing buttons. Basically, it is coding. It's all if then. I mean, if that's coding, right? If this happens, then this must happen. If not, then not. Here you go, Powell. Good evening or good afternoon or hi. Ooh, good afternoon. What is that? Bullish? Is that bullish? Good afternoon. Oh my God, this shit ain't moving. Market not even listening. They're listening to Iran and Trump news. You guys can hear Powell or not? He's like low, right? Barely. Listen to him. We're a little higher.
In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well.
Bro,
Other
500 rip
indicators,
down.
including job
Crazy.
openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable
glow
prices
here.
for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation,
5, 6, 8,
but it is too soon to know the scope and duration of the potential effects on the
volume
economy.
increasing.
We will continue to monitor the risks to both sides of our mandate.
Coming in now.
We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks.
Okay. Buyers coming in here.
our SEP,
800s.
FOMC participants wrote down their individual assessments of an appropriate path of the federal
stuff,
funds
right?
rate under what each participant judges to be the most likely scenario for the economy. The
Here's
median
the volume
participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision.
800s.
Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis.
I want to see absorption. I want to see a bullish
Fed has been
balance.
assigned two goals
right
for
here.
monetary policy: maximum employment and stable prices.
This is
We
absorption,
remain
bro.
committed to
For
supporting
my
maximum
liking, I want to
employment
see at least like a
bringing
bullish,
inflation sustainably to our 2% goal,
bullish balance here.
and
Green
keeping
marker,
longer-term inflation expectations well anchored.
more
Our
convincing.
success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity,
Questions
and a
coming
deep
up.
commitment to serve the American people. Thank you, and I look forward to your questions.
Coming right off value area low, and then let's see if it comes back into the value.
Thank you. Colby Smith
Attack
with the New York Times.
point of
There's
control.
been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So,
I
first
can
let me
answer
say
questions in like
we're
3,
well aware of
15.
the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 0.5 and 0.75, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context
All
of
green bars,
5 years now of
all
inflation
buyers
above
winning
target. We
at
have to
every
keep
price level
all
here.
of those things in mind, and the question of looking through when it does arise will be one to approach not lightly,
Short,
but
hold, orders.
in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so, there are 19 people, and so 19 reasons, 19 individual submissions, and if you notice, the median didn't change, but there was actually some movement toward, a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do, but essentially it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
Stock market?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down.
At 800, they were really trying to sell that right there.
How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid. And inflation, the overshoot is mainly from the goods and tariffs.
Buyers right here.
And, the labor market is
the unemployment
rate, of course, is little changed since September. You have a very, very low break-even rate apparently for new jobs, with little growth in either demand or supply. But the U.S. economy is doing
the mean right here.
pretty well. It's just we
If
don't know
if
what the
they could
effects of
push
this
here,
will be, and really no one does.
they have to push right here.
Mr. Chair, in the past, the staff has suggested that
Shit.
higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is
Got
there is
absorption
you
here.
know, the original thinking,
That whale got
the long-standing
semi
thinking
whale
is
here at
that you do look
342.
through energy shocks. But as I mentioned, that's conditioned on inflation expectations
That's
and
the
that kind
whole
of thing. So, sorry, your question was.
T20s has the whole here
What the
for
staff is
buyers.
saying about, and has said in the
Another
past,
buyer
So there'll be an offset.
buying over here at the
So
A20s.
that's true.
Go higher.
You know, we have, we're a net exporter of energy, right? So any effects on employment and economic activity
You
and
see
spending
from 10 to
would
342
be
there.
offset to some extent by the
That's
fact
more
that
than 3
our
times
oil
more
companies are
buyers
more
at the A20s
profitable
there.
and they may even do more drilling. If you ask oil companies about doing
They
more
have the
drilling, though,
markers here. It means
they're
a
going to want to
minimum
see,
times 3.
a
Minimum
consistent
times 3. So right here to right here, how
rise
many
in oil
times
prices
more
from where
buyers
they
are
were
right here?
before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful
Talking
judgment
about
that we're
oil.
going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening.
I will
Not
send
much
it,
of that
bro.
happening now,
Got
but
30
certainly
minutes of
could
talking.
happen over
Send
time
that
if you
shit.
see that.
Just
But,
say the stock market's going higher.
so the net of
Worry.
the net of the oil shock will still be some downward pressure on spending.
Just say we're
and
just gonna skip
employment,
the rates,
and
put it all to
upward
0.
pressure
Let's
on
go.
inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
You know, we have to do our analysis and
B20s
think these
line
things
is
through
saying
carefully. But of
buyers
course,
right
that's
now.
on everyone's mind. You know, we're well aware of the history, but you don't want to overreact to that. You know, you want to make the best judgment you can based on the facts. I don't think we're going to let it
That's it.
color our decision making more than is appropriate. It's
20
more
for
the
the 100.
fact that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be actually, and it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick.
Nick Tamaros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high 2s, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis.
Ooh.
And we're waiting for that process.
Ooh.
It takes 8, 9, 10, 11 months, a
And then
year to
that
go
was a
through
big jump
the
right
system.
there.
And we're waiting for the tariffs,
And
which were put in
push
place
more
over the
volume
course
came in
of
there.
the
Sellers
middle
came in
part
there.
and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive restrictive policy. It's coming from the one-off.
But when Powell used to
one-time
answer all these
thing.
questions, bro,
We
the
also
market
think
would
it's
go
important
go
to keep
insane.
policy either mildly
They
restrictive
don't
or close to that,
fuck
but not
about
too
this guy
restrictive
anymore.
because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower
This
rates,
guy don't
and
give
the
it.
risks to
I don't give
inflation
a
are to
f
the
about
upside,
this
which
guy.
would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Thanks, Chappelle. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world
sweep
where both supply
near
and
glow
demand for workers have come
going
down
downstairs
very, very
800. Let's see
sharply
if
over the
they
course of the
pound it.
last year due to
See if they pound it
immigration
here at
policy
800.
largely,
Come on.
a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that.
Man, that
Inflation,
London drop, and then we just OMC came out of London, and then they just found
inflation
balance.
2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time.
Take us
And that's
out
a
of this
concern.
balanced
We need to get
market.
back down to
Powell,
2%. And we
New
need to
York,
keep focused on
new
it.
New
We
York
do
low.
face some new inflation
Previous
from
day low
tariffs.
down
So
here.
I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens
I want to see a fucking
if
whale
there's
just
no
come out of
Federal
nowhere,
Reserve
bro.
chairman confirmed
Wow.
on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution
Come on,
and for
bro.
the people
Give
we
me
serve.
some.
Figuring you probably were going to set the dominoes off there, Edward.
Absorption down here.
I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
Zero prints down here.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly
Zero
there.
prints.
It doesn't seem from the projections or from the comments you've made today about the unemployment rate and
These are volume footprint candles, no
view on the labor market
indicators.
story
Not
for a large
indicators.
part
It's
being a
hard type
supply side story has changed.
on TradingView.
Despite the quite negative number in February, would that be the right take? And was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was
All right.
a
This
positive
holds. Stack bearish
surprise, and
balance.
the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low,
How many
non-existent,
views this
really,
guy gets on
growth
the
in
live?
labor force, which of course we've never had in our history.
Damn.
So you've got
29K
sort of
watching
a
this guy.
zero employment growth equilibrium. Now that's balance, okay, but you know, I would say it does have a feel of downside risk,
Well,
and it's
can we
kind
get
of a really
one?
comfortable balance. So you know, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero. But nonetheless, it's something we're watching carefully, and you know, are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of
This is the
military action.
NASDAQ.
So
NASDAQ
I
futures.
don't know that the
NASDAQ futures.
the world has changed in a way that there'll be more supply shocks. But you know, people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have have a
Bro,
committee behind that. So
what the
we
fuck?
didn't make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that
EV stay low.
that our next move might be an increase did come up.
Time.
Did at the last meeting.
It's time.
The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question now?
I was just one question there, but follow-up. There are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing, that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. And your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for
Come on.
and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves. With what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time
1 second. 1 second.
increase in the price of a good, right? And what inflation is ongoing increases in
Bro.
prices this year, next year, the year after. That's what inflation is. It's not a one-time
Close the door
price
up there.
increase. There's a very, very
Close the door.
big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is very uncertain.
See if it just
We
rips.
found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. And so I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing. It's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc, and for all the tariffs they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
High levels of uncertainty.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive, real earning gains.
3 more minutes. He's about to close it.
Again, we think.
He's about to close it.
But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from
Hell,
inflationary
name
pressures
sleep,
that
bro.
take a while to get to the price, into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know, what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or a specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices, so your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to.
So I think it's a more general concern.
Boring. Powell, you're boring.
That's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that, and we're watching it, but you know, we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Last question, pal.
Just to sort of
Make it count,
step
baby.
into the future for a little bit, I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side? And I think
Oh,
we just
bro,
don't
you
know that answer ex ante going
ain't
in.
doing nothing right
We'll just have to wait and see. Thank you very much.
now. Sideways. Sorry, he's done. He's out. He's out now. Now you can pump it up. You got to pump it up. All right, let's see if it's gonna hit previous day low here. I want a nice reaction. Previous day low. Look, it also is one day's value area high. Think we're gonna get a good strong close here? Do you think? It was weak today, bro. I was like, yo, I'm gonna go live because these candles are gonna go crazy. Now let's just read order flow while we're going through these candles. But all of this week, bro, all of this week's been fucking crazy. No whales Monday. Couple of whales yesterday, but the early bird whale yesterday. Today just went nowhere. All balanced. See, I'm gonna stay here until it hits previous day low, and that's it for today, man. I guess FOMC is not FOMC anymore, bro. It's just like it's like FOMC minutes. You know, when they release the document, just like that, no movement. Just like he's speaking, whatever. Fuck him. See what they said on Twitter, bro. Previous day low. Previous day low. All right, a lot of volume here. Volume here, previous day low here. Did not do anything. Small whale right here. See if that's enough for it to go higher. confirmation here to the downside. Trying to hit monthly open here. Right here. Oh, yeah. Real incoming right here. Come on, boy. Damn, they pushed. Damn. Flip green. Delta flip green. So 715, 720 area right there. Let me change that. Yo, 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 yo. Gotta use the bathroom. Gotta use the bathroom. All right. Boring. You ain't going nowhere. You ain't gonna do shit, NQ. You ain't doing nothing. You ain't gonna do shit, NQ. You ain't gonna do nothing. All right, that gotta go down as the worst fucking FOMC ever. Just get stuck here at 720s, 700s. gonna be out of here, man. I'm literally bored as fuck. So I don't trade PM session. My setup doesn't come here, man. That's it. I'm getting sleepy watching fucking paint dry here. Man, on the 5 minute look, we dipped. Let's see, we dipped about 160 points, but not because of volume, bro. It's just dipped. There's no volume. We dipped because there's no fucking volume, bro. Hold on. Hold on 1 second. What's up, bro? You okay? Close the door up there. Alright. Fuck it. What a boring fucking day. I mean, boring FOMC. I wish it was better for you guys to see. Um, but yeah, it was just a boring ass move down, bro. No fucking volume. Um, yeah, no volume at all, man. The last 30 minutes is probably gonna be the same BS shit. It's gonna chop sideways. MOC orders are gonna come in. 350 is gonna go up and down and just stay around 700 probably. If you like watching this fucking chop, that's all for you. For me, fuck that shit. All right, guys. I'll catch you on the next live later.